Hey all, welcome to ShareTrek. This is Raj here, and in ShareTrek India today we are going to talk about bonds. This is the fourth episode in our Invest in India series, and as always, I have my brother and best friend Kumar out here to give us a lot of information. He has tremendous experience in the area of investing in India, so I'd like to take the benefit of his expertise. And today's topic, as I said, is bonds. So welcome, Kumar. How are you today?
I'm good. Thanks for inviting me.
You're welcome. And Kumar, can you get us started with bonds? What are bonds? What can we do in India? What can NRIs do? What can local people do? How to use it in the portfolio?
Definitely. To start with, the previous episode, we did something called fixed deposit or term deposit, which we said is you are lending somebody money. Now, bonds are similar. You are lending. When you buy a bond, you are lending. Only thing, the instrument is different from fixed deposit because fixed deposit is not tradable. You put money with some a counterparty, you take the money back from them. The only way for liquidity is either you break that deposit or you take a loan against it as a collateral, using it as a collateral. These are the only options available for you. Whereas bonds are a totally different set of instruments which helps the counterparties, whoever it is issuing the bond, to raise funds. And it is reflected in their balance sheet as debt. So it is basically their borrowings. And it's usually for a tenor. Now, to understand bonds, basically it's a instrument they issue. Like when you invest in the share of a company or you invest in some other activity where they give you a document of title. Similarly, this is a document which is called bond. Bond basically reflects that it is uh, amount of borrowing that a particular counterparty is doing, which is broken into fixed amounts. So, for example, they want to borrow something like 1 million, they may issue 100,000 bonds, each of 10,000. So that way, each bond is of 10,000. Accordingly, you will have to apply. So you can only apply for say 10,000 or 20,000 or 30,000 as per your ability to invest in that. So the bond is basically denominated for a value, and it is issued as number of bonds, and it will have a interest rate, which usually in common market terms is called as coupon rate. So don't get confused when you hear the term coupon rate. Coupon rate and the interest rate are same. So it is a rate that this bond will pay, and there will be a definite tenor for the bond. So the bond could be for 1 year, 10 years, 4 years, 5 years, 6 years, because the company or the counterparty is issuing this bond for a specific purpose. And that purpose, they know the timeline of recovering that money after having taken the borrowing, investing that borrowing, and generating revenues to repay that borrowing. They have a timeline calculation which they do before they even raise the bond. So the tenor is fixed accordingly. And the coupon rate either can be paid on maturity or it can be paid on a regular frequency. That is up to what the issuer is comfortable with. You don't have a say in any of it. It's the company which decides. They sit with their bankers and their CFOs and they decide what is it that is feasible for the company to issue and raise the funds. Now, the main criteria of the rate of interest, how do they work on the rate of interest is, one is what is the interest that the company is willing to pay. That's one part. And second is most of the bonds have to be rated. So there is a rating agency which will come, which will analyze the issue. They, not necessarily one rating agency, it could be more than one rating agencies which they will call, and they will analyze the bond issue, they will analyze the company, look at their repayment ability, look at their funding ability for interest payments, all of it, and how good they are placed and what has been their track record in the past. So multiple factors go into the rating agency analysis of that particular bond, and they will give it a rating. The stronger rating you have, the lesser the coupon rate will be.
Right.
The bad rating will reflect that you will have to pay a higher coupon rate because that's a more risky issue compared to the market risk appetite. So you have to pay a more interest in order to attract people. So the rating itself is done before the bond is issued. So the company knows that what is the range in which it has to issue a interest rate. Now, if that interest rate is unviable for the company, they may not issue the bond because they need people to subscribe, and the interest rate is the benchmark against the rating and the market conditions. So similarly, similar nature of companies or bonds which are being issued with similar tenors, similar terms, and if the rating is bad, then they have to pay a higher rate of interest. So they will look at their peers and competitors, and almost all organizations issue bonds. So this is how bonds come into play. They get issued. So you can subscribe for these bonds, and it gets allotted to you, and you hold the bond.
Right.
Now, bonds can be issued by almost all corporate entities, including the government, the local government, the state government. So even municipalities can issue bonds. So you have state bonds, you have country bonds, your RBI issues bonds. So almost all organizations of statutory and legal and corporate bodies have the ability to issue a bond. Now, again, as we talked about deposits, when it is a government deposit, it is lower rate of interest because the rating itself becomes better.
Right.
Inherently, because the sovereign risk is always considered as the lowest risk, and that is also a factor which goes into a rating. To explain this in case of bonds specifically, which will make sense to you because in deposit it's difficult to explain, but in case of bonds, we can explain it much better. For example, if there is a new entity which has been set up in India by a foreign company. So maybe the company is from Europe or US or North America, which are based. They have set up a business here, and it has been some 5 or 10 years in existence in India, and now they want to raise bonds. So when their rating is being assessed, there will be two sets of sovereign ratings they will look at, which is the parent country and what is the sovereign rating of that parent country, then compare it with the local entity, and then do the sovereign rating average. For example, if the parent company is in the US or say in Germany or France, the sovereign rating will be much better. But if it is in a place like Vanuatu or Colombia or Venezuela, the sovereign rating of the parent company will be very bad. That will impact the rating here in India. Because if the parent company has a problem, this company will also have a problem. So rating plays a very important role in the bond sector and ability to generate the borrowing that it needs. There have been cases of default in case of repayment of bonds. And in case of the organization goes bankrupt, you will know your bonds will have some repayment capacity because they are basically bonds. It's an actual document which says that we have to pay you back.
You're a creditor.
You're a creditor. And the quality of repayment or the hierarchy of repayment would depend as to what type of bond you have purchased. There could be a bond which doesn't have any underlying security. But there could be bonds which are having securities underlying it. They will say these bonds are secured by, so they are called secured bonds. So they have some security behind them, which the offer document will state what is the security which provides a collateral for this particular bond. So the quality, the value of security, all this also goes into the rating, plus it's also information that you need to have. For example, if the collateral is receivable and the company goes into bad times, the receivables will actually dry up.
Right.
So it doesn't become any valuable. But if they say that my property and buildings and land are the collateral or plant and machinery, you know there is a recovery value for that. You can at least sell it in the market and get some money out of it, which will be better than something which keeps fluctuating. So that's one part of it. Now, the best part about bonds is it's tradable. It's a market instrument. Unlike deposits, if somebody issues the bond, you purchase the bond. These can be traded in the secondary market. Most of the capital markets has a very active bond market, and there these bonds get traded. Now, bonds are of different tenors, as we already explained. It could be for 6 months, 1 year, 2 years, 5 years, 10 years, 15 years.
Yeah.
So what happens is, when at a point in time when these bonds are issued, there is a particular interest rate level that is in the economy. So you could have a high interest rate time when the inflation is going up, so that the inflation can be curtailed. If there is need for building inflation because it has gone into depression, then the rate will go down. So at that point in time, the market, the interest rates will be low. So a bond issued at a low interest rate time will have a lower coupon rate. A bond issued when the interest rate in the economy is higher and they have to benchmark their issue with that interest rate, then say, to explain this specifically, suppose the average interest rates at that particular, on a particular year one is 5%, and there is a bond which is issued at that point in time for a 3-year tenor, then maybe they will price it at around 6 or 7 or 8. But if at the average interest rate is at that point in time somewhere around 8% or 7%, then the bond will be priced at around 9 or 10% for a same tenor of 3 years. Because the market rate of interest has a direct impact on bonds.
Right. So they are trying to compensate. Any buyer of a bond will see that he doesn't pay more for the bond, so that the rate of return is equal to or better than what is available in the general market when he pays to buy that bond.
Correct. See, because if you consider the return and risk ratio, the higher the risk, the higher the return. So when you are investing in a fixed deposit, it is lower risk. Whereas when you invest in a bond, it is higher risk, so the return has to be better than term deposits. So bonds usually carry a coupon rate which is much better than deposit rates at any given point in time, unless it is very short term. So if it is very short term, then the rate of interest may be good, but the amount you get is less because it's very
Right.
short term. The interest earned is treated same as the term deposit for the taxation purpose. So what happens is these bonds, once you purchase, if you want liquidity, you can trade them. So there is a capital market which is open, which is available for trading in bonds. So you can buy, sell bonds, and that's it. It's as good as any other marketable instrument. This is the main difference with term deposit. You can't do this with term deposits.
Right.
So plus you can also use it as a collateral if you want to bond.
Right.
And in fact, for bonds, the haircut is much lower. Much lower. So in the case of a deposit, if they do a haircut of 20%, here they may do a haircut of only around 5 or 10%.
Right.
So you get much more money against a bond when you borrow as a collateral compared to even a deposit. So that's the second part. Now what happens? Why is bonds actively traded? And recently you must have seen over the past 1 year that yields have gone up, yields have come down, yields have remained stagnant, and that's why this is happening, that's happening. The market funds have moved to that, funds have moved to this. Exactly what is this yield? We are talking of coupon rate and interest rate. Then what is yield? That becomes a question mark if you're going to invest in bonds, and you need to understand what is yield. So, for example, what happens? Suppose 3 years back, a 10-year bond has been issued for something like 7%. Now, the economy changes, the market changes, the government changes its interest rates and everything, and say 3 years down the road, you want to sell your bond. It has got an interest rate of 7%, and it has got 7 more years to go before it matures. But today in the market, if you go, because there has been some post-COVID recovery, interest rate hikes and everything, and in the market over this 3 years period of time, the average rate of interest has gone up. And today, if a bond issuer was to issue a 7-year bond, he will have to pay an interest rate of 10%.
Right.
So why would somebody buy your bond, which after 7 years will give him 7%?
Right.
Nobody will buy. So what happens is, in the market, you discount the value of your bond. So that if today somebody is buying, at the end of 7 years, they will get 10%.
Right.
So basically, you are letting go of 3% of your interest that you are going to earn.
Right.
And you sell it at a 3% discount. So when they buy it, because of that 3% discount, they are going to get 10% at the end of the 7th year.
Right.
So what has happened? The yield on your bond has gone down.
Right.
Whereas for the buyer, it is a benefit because from day one, he is getting a 3% discount on the fair value of the money.
Right.
For him, the yield has increased.
Yeah.
And it will work in the reverse way in case interest rates go down.
Yeah.
So 2 years down the road, if you're selling a bond and the interest rates have gone down, then you can ask for a premium saying that this bond is going to give you more return. So basically, this is how the demand and supply of bonds work based on the tenor, the rate, coupon rate that it carries and all of it. So basically, why did money move from the equity market into the bond market is because if you're buying at a 10% at a point in time when interest rates are high and you invest into bonds, then when you sell even at a lower interest rate, you can earn a premium.
Yes, because when the interest rate goes down, people will have to pay more to buy the bond in order to
Absolutely.
get that lower interest rate. So you can demand higher money. So with bonds, you make money
Because-
two ways. One is hold longer and get the interest, or
Correct.
the second is get capital gain.
Correct. But here the thing is premium. It's a
Yes,
question of premium. So if
premium.
you are getting a 10%, you have a 10% bond which is going to mature in 5 years time and pay you 10%. And if the market rate has gone down to 7%, you can say, why should I sell this? You
Right.
want this? Okay, give me 3.5% more.
Right.
So that you make a 0.5 more on that. That speculation also happens because it's a tradable instrument and
Right.
you get to benefit it.
Yes.
Now, bonds, this is simply about bonds, how it works, and it's a debt instrument. So if you're making a portfolio of investment,
Right.
this is not equity, this is not commodity, this is debt.
Yeah. Yeah.
So you have to be clear as to debt means what. So in debt, you will have things like term deposits, you will have bonds, you will have debentures, and you will have other products which are debt related. Now, there are two other aspects or modifications or changes that are happening. For example, there are a few companies in India. What they do is basically they, like we talked about in our introduction, we talked about some of those startups which actually take up a big chunk of assets of a lending company. They place it with a trust and then they issue bonds against that.
Right.
And these bonds are issued for retail investors to invest in. So it works out as a win-win situation for the lender
Yeah.
because he gets his capital freed up because this guy pays him. Then these assets are again start generating revenues because they are issued as bonds. And on bond, the coupon rate takes care of the return are higher than the coupon rate they are offering. So you get a much better deal. Number two. Number three. There are mutual funds, there are ETFs which invest in bonds.
Right.
So they specifically say we will invest in bonds and what nature of bonds they will invest, short term, long term, liquid. The multiple types of bonds are available, which have different focus areas and they invest in that. And like I would here like to mention one of the ETF which is available in India, which makes a lot of sense because remember, bonds have a high ticket value.
Right.
Bonds are not available at 100 rupees, 200 rupees, 300 rupees per unit. They are usually starting from around 10,000 and going right up to something like 10 lakhs or 50 lakhs for one bond.
Right.
So it's basically used by institutions to buy into to generate revenue. But nowadays, they are also trying to target the retail market. So their values have come down to an extent. But what happens is the best of the bonds do not have to do that. The best companies or the AAA rated companies do not have to do that. They don't have to attract retail investors. They are very well rated. They are well established. So when they issue a bond, there are people who would just take it up. So what happens? You as a retail do not get access to it, and mutual funds or ETFs are basically instruments to get the retail to participate in the big ticket items. So there are. I'll mention one ETF because I myself am invested. It's a disclaimer kind of a thing. We are not recommending you invest, but to explain the nature of the product, we are explaining this. There is something called Bharat Bond in India. They have a very clear scheme strategy, which is very clearly mentioned. They are going to invest only in AAA rated government bonds. They will not invest in anything else. They'll only invest in AAA rated government bonds. So you on an individual basis, if you want to go and invest in any of these bonds, you will have to shell out at least 1 lakh for one bond or 10,000 for one bond or 50,000 for one bond. In case of Bharat bond, you can have one unit of that Bharat bond for as low as 100 rupees.
Right.
So as a retail investor, if you want to do some quality bond related investment, If you are investing in something like ETF, it is a passive investment, so the cost expense ratio is less. Plus, the underlying instrument is AAA rated government bonds. So you can't get it much wrong.
Yeah.
Plus, this as an ETF is also used for collateral, and it has got a very low haircut, 5 to 10%. So the liquidity is also high. Not only that, irrespective, if you buy a bond, the bond will have a tenor of 5 years, 10 years, 15 years, whatever it is. In case you buy into an ETF which is investing in these kind of quality bonds, there are several. Bharat Bond was an example because it stands out. It only invests in AAA rated government bonds. So it was a good example to give. But here you invest in an ETF. ETF, you can exchange traded funds. So you can trade it in the exchange any point in time. You have a demat account. And if you're buying it, you will have a demat account. You will have a trading it account. You are buying the ETF. You can sell it any point in time. So it's got, you don't have to hold it for as long as the underlying bond is there.
Right.
So if the underlying bond is for 10 years, you can buy the ETF today, and after 6 months you want to get out of it, you can sell it and you can get out, so on and so forth. Not only that, it gives you a benefit with ETF that the underlying fund manager will be managing the bonds. So they will manage all the maturity, reinvestment, all of it they will manage. Any new bond comes, they will invest, which is government AAA rated. So all the study will be done by them, and you will get access to the bond market. So this is basically a small explanation about bonds. And bonds we took next because it gives you a return higher than deposits in most of the cases.
Right.
In case if it is a junk bond, which is basically junk bond basically means a bond issued by a company which is may or may not repay it. It's in very bad shape. The rating is junk. But the return rate will be very high. The speculation on it will be very high because it's a traded instrument. So if you're having very short-term view, you can trade on that bond.
Right.
And make quick money if you have some knowledge of how to trade in the bond. So basically, this is the first market instrument we have talked about, because term deposit is not a market instrument, but bond is a market instrument.
Right.
And bond is similar to deposit in so much as it is something that you are lending money to a counterparty.
Right.
They are giving you a document. It has a coupon rate similar to an interest rate for a term deposit, and it's tradable. And you have got other derivative products which are there.
Yeah.
Which also allow you to access the big ticket bond market and have liquidity at all points of time, and have an asset which is collateral based. Plus, it helps you diversify your overall portfolio.
Wonderful.
So that's the bond basics that I wanted to share.
Wonderful. And I believe that we also have bonds in India that are specific for specific purposes. I remember selling a house at one time, and in order to avoid capital gains tax, I had put that money on infrastructure bonds for 3 years, got a good interest rate, and at the end of it, I got my money back, and I avoided all the capital gains tax. So those opportunities are also there.
Most of the bonds are for a specific purpose.
Yeah.
Most of the bonds are. And in India, what is happening is basically India has been investing in infrastructure over the past 8 to 10 years in a big way.
Yes.
And when you invest in infrastructure, you need to generate funds. So if it is not a border roads organization or something which is to do with national security, it is a government which is raising funds in order to build that infrastructure. So when it is raising funds, these funds are invested, majority of those funds are raised by way of issuance of bonds. So when you talk of infrastructure, it may be for building roads, it may be for building schools, or it may be for building godowns, it may be for warehouses. So these are all infrastructure projects which the government undertakes, airports. So they will issue bonds. That is one thing. When you talk of infrastructure bonds, you could have a generic infrastructure bond by the government, which is issued by somebody like NHAI or something, which is the National Highways Authorities of India. Yeah. But you may also have specific bonds saying that this is a major big ticket project and we want to raise funds only for that. So the authority which is authorized to do that construction or deliver on that project can raise bonds.
Right.
So even a special purpose vehicle that you set up can raise bonds. So many times you set up a special purpose vehicle, maybe you are having a big infrastructure project in the country and you are having more than one country participate in it. So they may all become part of the joint venture. And in order to raise the funds, that joint venture can issue bonds. There is a full process of issuing the bonds, which has to be vetted and everything.
Right.
And there is a listing process of the bonds so that they check everything is in order. So, and so it doesn't make much of a difference because you don't have to do all the due diligence. There is a process which undertakes the basic due diligence that is required for a bond to be lifted. And it basically depends how long you want to be invested in bond. And it's a debt instrument. That you have to be very clear.
Yeah.
It's a debt instrument, so this forms part of your debt portfolio.
Right. And from the point of view of the NRI, I found that NRIs living in North America cannot invest in bonds because of FATCA related stuff. But I think based on what you said, maybe they could invest in bonds through ETF if they have a trading account.
No, actually, that's not the case. I'll explain this very clearly. Basically, what has happened is FATCA, which has been issued by US, it has put in what you call when a country or in an organization complies with FATCA in any geography, it basically means that they are agreeing to the US term that they will do reporting as required by the US of any US national doing a transaction in that country. So when a country ties up and says, okay, I agree to FATCA guidelines, then they have to do this. And if a country says that, no, I don't want to comply with FATCA, I don't want to take on this responsibility, then in the US market, because the US dollar transaction happens through US, they charge a higher transaction charge. So your international transaction becomes costlier for you. So majority of the countries have signed up for FATCA. Now, what this does is it places onus on people or organizations within that country, which are going to deal with Canadian and US citizens to do the reporting. So there are many of the organizations, especially AMCs, if you look at it, they don't want that additional burden because they work on a fixed, limited, mandated expense ratio. So if they want to do something more, their cost goes up and they have a limited expense ratio within which they have to work.
Got it.
So most of the AMC, what they say is, we don't want to deal with US and Canadian customers because if we deal with it, then we have to ask all our other customers also to say you are not US or Canadian.
Too much headache.
And if US or Canadian, then every time you do a transaction, I have to report it. And if I don't report it, I get penalized.
Yeah.
So the easy way out is to say, okay, I don't want to deal with that geography. So that is the issue why NRI specifically from US and Canada, not other geographies. Europe, Middle East, and other parts of the world, this requirement is not there because they don't have this reporting requirement.
Yeah.
That's where the issue is that you have a problem with investing. Like, for example, the Bharat bond I quoted is with Edelweiss. Edelweiss AMC has issued this Bharat bond. They don't take on American and Canadian citizens. So you actually cannot invest in that ETF. There are, as of now, there are around 12 AMCs which allow people to invest in India from US and Canada, but they also have very different varying requirements. Only 2 of them have, you can deal online.
Right.
Remaining, the first transaction, you may have to do it in physical form, or you may have to give a declaration every time saying that I did this investment when I was in India.
Right.
All those kind of requirements exist. That becomes very cumbersome for somebody to invest.
Yes.
So you may be able to invest directly in a bond. But then, as I said, the ticket size is big. Usually bonds, when you buy, the ticket size is big.
Got it. So Kumar, that was a very interesting summary of, not summary, detailed description of bonds and how it can be used in India. So with this, I think we have successfully completed 4 episodes of this series, and we have covered along the way. We have spoken about fixed deposit, then we have spoken about gold, we have spoken about bonds now. So what is the next episode going to be on?
You have any ideas?
Maybe we go for shares.
Yes, let's go for equity shares.
Yeah, let's go for equity shares and how local people can participate as well as NRIs can participate in the Indian equity market, how equities are issued, what kind of accounts you need for that. Maybe we can cover those things in the next episode. So
Definitely.
thanks a lot, Kumar, for a lot of information. And viewers, I hope you like this episode. And as we go with subsequent episode, we'll be going into more and more sophisticated instruments. And finally, we'll be talking about the market. And probably we'll also talk about stocks, but not as advisors, but just giving our opinions to you about what is likely to happen to various stocks and various options and those kind of instruments. So stay tuned. And if you're interested in these kind of contents, please subscribe to the channel and press the notify button. If you like this video, please press a like out there and help the channel grow. And thanks, Kumar. Thanks once again for joining us today.
My pleasure.
Yeah. Bye, friends. We'll catch up with you in the next video. Bye for now.